The biggest risk to the United States economy was never the AI bubble. It was never trade wars. It was never the deficit. And it was never whatever geopolitical crisis dominated your newsfeed last Tuesday for about 48 hours before everyone forgot about it. It's something far more boring, something that doesn't trend, doesn't go viral, and definitely doesn't have a charismatic CEO you can either worship or despise. And that's exactly why nobody's paying attention to it. Because if you've been wondering why mortgage rates refuse to fall even when the Fed is cutting, why stocks randomly freak out every few months with no obvious trigger, or why financial conditions still feel weirdly tight despite everyone in Washington telling you the economy is fine, the answer doesn't start in Washington. It doesn't start in Silicon Valley. It starts in Tokyo, and more specifically, in the most unglamorous corner of the entire global financial system. Japanese government bonds. Stay with me here. Because the country best known for exporting anime, vending machines with questionable contents, and the concept of extreme workplace politeness has also been the duct tape quietly holding the global financial system together for the past 3 decades. And that duct tape is starting to peel. And when it goes, it's going to affect your mortgage rate, your portfolio, and your retirement account, whether you've ever once thought about Japan or not. To understand why, you have to go back to 1992. Japan in the early 1990s was the economic envy of the world. Real estate prices in Tokyo were so absurd that the land under the imperial palace was, at one point, valued higher than the entire state of California. That's not a metaphor. That actually happened. And then, the way all great bubbles do, it ended. Real estate collapsed. Equities collapsed. Banks were left holding worthless assets, and the whole economy hit a wall it didn't see coming. What followed was called the lost decades, and lost is being generous. It was a 30-year stretch of near zero growth, near zero inflation, and near zero wage expansion. The Japanese economy didn't crash and burn dramatically. It just quietly flatlined, like a patient in a coma where everyone in the waiting room slowly stops visiting because nothing ever changes. So the Bank of Japan did what central banks do when they've run out of normal options. They cut interest rates to zero. Then, when that wasn't enough, they went below zero. And then, but when even that wasn't moving the needle, they introduced something called yield curve control, which sounds like the name of a Marvel villain, but actually just means the government decided to manually cap long-term bond yields. They essentially superglued interest rates to the floor and dared the market to argue about it. And that created a problem. A very large, very quiet, very consequential problem. Because imagine you're a Japanese pension fund sitting on $1 billion portfolio. Your job is to generate returns for retirees. And your domestic government bonds are paying you 0%. Actually, sometimes negative 0%. You are literally losing money by holding the safest asset in your own country. So what do? You go shopping, overseas. And that's exactly what Japan did. For 3 straight decades, Japanese institutions, pension funds, life insurers, regional banks, and individual investors poured money into foreign markets. At its peak, Japan became the single largest foreign holder of US Treasuries. They became one of the largest buyers of US mortgage-backed securities. And they became the world's largest net creditor nation, which is just the formal way of saying Japan became the world's ATM. The money that flooded out of Japan and into global markets over this period is estimated by various banks and institutions to be somewhere in the range of $4 trillion. $4 trillion. And the mechanism behind all of this had a name. It was called the yen carry trade. And here's how it worked. Say you're an investor. Let's call him Bob, because financial disasters always involve a Bob. Bob goes to the Japanese financial markets and borrows money in yen at near zero interest rates. He then converts that yen into US dollars and buys US Treasuries yielding 4%. After fees and hedging costs, Bob pockets a comfortable spread. Pure arbitrage, free money. Or at least, that's how it felt for a very long time. But here's what made the carry trade truly enormous. When your borrowing cost is effectively zero, you don't just buy boring treasuries. You buy tech stocks. You buy emerging market debt. You buy US real estate funds. You buy anything with a pulse that yields more than nothing. And that's exactly what happened. The yen carry trade wasn't just funding bond purchases. It was quietly providing liquidity to nearly every asset class on Earth. It was the hidden engine running underneath global markets. And almost nobody was talking about it because it wasn't making anyone uncomfortable. Free global liquidity tends to have that effect on people. The entire trade, however, rested on one single assumption, one load-bearing wall that had to stay standing for the whole structure to hold up. And that assumption was this: Japanese interest rates would stay near zero. Forever. They didn't. In 2024, the Bank of Japan ended its yield curve control policy and raised interest rates for the first time in 17 years. And then they raised them again. And the reaction was immediate and ugly. The day following that second rate hike decision, the S&P 500 dropped 6%. Japan's own index, the Nikkei 225, plummeted more than 12% in a single session, its worst single-day drop since 1987. $1 trillion in global market cap evaporated in about 8 hours. And that was just the warning shot, because here's what actually happens when Japanese yields rise. First, borrowing in yen gets more expensive, so the cheap funding source for the carry trade dries up. Second, hedging the currency risk between yen and dollars gets more expensive too, so even if you stay in the trade, your margins get crushed. And third, and this is the one nobody's modeling properly, the capital that spent 3 decades flowing outward starts flowing back. This is called repatriation, and it's the part of the story that makes seasoned investors go quiet. Because when Japanese institutions start bringing money home, when they start selling US Treasuries, US mortgage-backed securities, and foreign equity positions, the demand side of the global bond market changes. And here's where it starts affecting you directly. Even if you've never once owned a yen in your life, here's the part most people completely misunderstand about the Federal Reserve. When Jerome Powell cuts interest rates, he's cutting short-term rates, the overnight lending rate, the rate banks charge each other to borrow money for 24 hours. That's the lever he pulls. But your mortgage rate? Not controlled by Jerome Powell. Your mortgage rate is anchored to the 10-year Treasury yield. And the 10-year Treasury yield isn't set by any central bank. It's set by supply and demand, which means the Fed can cut rates all at once. But if the demand for long-term US Treasuries weakens, the 10-year yield stays elevated. And if the 10-year stays elevated, mortgage rates stay elevated. Full stop. And that's exactly what we've been watching happen in slow motion. The Fed cut rates 3 times in 2025, and mortgage rates barely moved. Everyone was confused. The financial media kept blaming Jerome Powell, but the real issue was on the demand side of the bond market, where one of the most consistent, price-insensitive, multi-decade buyers of long-term US debt was quietly stepping back. Let's make this even more concrete, because it's not just mortgages. When analysts value stocks, they use long-term interest rates as the baseline discount rate. The logic is simple. If risk-free assets are paying 5%, then the future earnings of a company need to clear that hurdle to be worth anything. So when long-term yields stay high, the present value of future earnings gets compressed. And stocks that were priced at 35 or 40 times earnings when rates were near zero suddenly look a lot less attractive when the 10-year sits at 4.5% or higher. This is why you can have corporate earnings that look fine, an economy that technically isn't in recession, and a stock market that still feels like it's one news headline away from a 10% correction. The valuations were built on assumptions that required cheap, abundant global liquidity, and the source of that liquidity is changing. Then there's corporate credit. Because when rates were suppressed in 2020 and 2021, companies issued debt like it was a clearance sale. Investment-grade bonds, junk bonds, leveraged buyouts, all of it got done at rates that look insane in hindsight. And much of that debt is coming due over the next 3 to 5 years and will need to be refinanced. At current rates, into a market where global demand for duration has softened. For companies with strong balance sheets, that's manageable. For companies that use cheap debt to paper over weak fundamentals, that's a problem that's going to show up in the earnings reports of 2026 and 2027, and nobody's really factoring it in yet. So let's zoom out and state the whole thing plainly, because that's actually the point of this channel. For 30 years, the United States ran a structurally advantaged position in global capital markets. We issued debt, and Japan, essentially on autopilot, bought it. That kept our long-term borrowing costs lower than they otherwise would have been. That kept mortgage rates lower. That kept corporate borrowing cheaper. That pumped liquidity into equity markets. And it happened so quietly for so long that an entire generation of investors, analysts, and policymakers just assumed it would continue indefinitely. It was the background radiation of global finance. Nobody noticed it because it was always there. Now it's changing, not collapsing overnight, not triggering some immediate 2008 style event tomorrow, but shifting, structurally, in ways that have compounding effects across every asset class simultaneously. And the reason financial media isn't covering this is simple. It doesn't have a face. There's no villain you can put on a thumbnail. There's no single dramatic moment. There's no political angle to make it tribal. It's just a slow, technical, multi-decade structural shift in global capital flows. And explaining that requires 3 minutes of setup before you can even get to the interesting part, which is not exactly a recipe for 8 million views on a finance TikTok. Instead, the narrative stays simple. The Fed cuts rates, financial conditions ease, everything's fine. Except that's only half the equation. And the half they're leaving out is the part that's already showing up in your mortgage rate, your portfolio's volatility, and the weird dissonance of a market where the Fed is cutting and conditions still feel tight. So here's where I want to leave you, because I think this is actually the most important question in markets right now. And it's one I'm curious to hear your take on. Do you think, A, the carry trade unwind is already mostly priced in, and markets can absorb it without a major dislocation? B, this is a slow-moving structural shift that quietly grinds down valuations, credit conditions, and housing affordability over the next 3 to 5 years? Or C, the real blow-up hasn't happened yet, and we're still in the early innings of something that ends badly? Drop your take in the comments, because this is genuinely one of those situations where the range of outcomes is wide, and reasonable people can disagree. But what's not debatable is that one of the largest and most consistent sources of global liquidity for the last 30 years is quietly changing course. And the fact that most people have never even heard of the yen carry trade is not reassuring. The most dangerous risks in markets are never the ones everyone's watching. They're the ones hiding in the footnotes of a Japanese central bank policy meeting that didn't even make the front page. And that's exactly why I'm watching it.